Hello and welcome. This is the Insurance ProBlog Podcast. This is episode 433. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance. More specifically, index universal life insurance. More specifically still, volatility-controlled indexes of index universal life insurance.
Henceforth, they shall be known as VCIs because
that's easier to say.
I can't be trusted to say volatility control index over and over and over again.
We already had a little fumble as we were getting ready for this. So
my brain moves way faster than my tongue is capable of doing. So
that happens.
Yeah,
that happens.
Yep.
And we do our very best to start the podcast in such an obscure way. Most people are like, I'm going somewhere else.
Yeah. Well,
but hey,
VCIs have, they're not brand new to these products.
No.
And they sound incredibly complicated.
Yeah.
But at least I hope that we can communicate over the next little bit here that it's not that complicated.
We came with 3 objectives.
Oh,
we want to tell you, we want to tell you what they are. We want to tell you why the industry is using them. And then we want to discuss, are they of any benefit to the end user?
Yeah.
So if we can address those 3 subjects by the time we're done today, we'll have done more than many, many of our other podcasts.
Well, the clock's ticking.
It is.
Yeah, it should only take about 10 minutes to answer those questions. Okay.
But we're going to do what we do and try to drag it out for as painfully long as we can.
We're going to have to vamp for an extra 20. That's all right. So what are they?
So a volatility controlled index is an index that seeks to control volatility.
There you go. That sounds like it was a test question in high school that you didn't know the answer to.
Oh,
I tried that a time or two.
Brings back memories, personal memories of adiabatic cooling for me. Freshman year, first semester of college, I was in a geography class that was very scientifically skewed. And professor spent a lot of time talking about that. I thought
we were going to look at maps and stuff.
I did too. I thought, I can memorize the rivers in China. That's not what it was. Yeah, professor talked a lot about it during the first half of the semester. So you'd think I would have known what that was by the time the midterms came around, but I did not. And so 40% of the midterm was an essay question, which was explain the process of adiabatic cooling. And you know you're in trouble when you begin your essay answer with the sentence that says adiabatic cooling is when the air cools adiabatically.
Yep.
Needless to say, Brandon received 0 points for that.
I was about to say
essay answer.
That's when you realize the best I'm going to do is a 60 on this exam. Best. That's if I get everything else right.
Yep.
Yeah, that's rough. I had those experiences. But you always roll the dice because you're like, what's the chance they're not going to fully read these? You might slip one by occasionally. So
you do try. Yeah. In that case, that didn't work.
No, in college it never worked because TAs grade the papers and they're, they got to prove their worth and all that sort of stuff. So.
Yep. So a volatility controlled index is an index that seeks to minimize loss, basically.
Yep.
By reallocating the index composition between a risky asset, stocks, and a low risk asset, cash or bonds.
Right.
And it does it based on various volatility measures and the benchmarks established for the index for that volatility. So for example, if an index is targeting a certain volatility benchmark, let's say it's 5%. As volatility gets closer to exceeding that amount, the index composition will shift more heavily into the low risk asset, bonds or cash.
Right.
But as volatility pulls away from that benchmark, the index will now move more heavily into stocks.
Right. And it's not all at once. It's a gradual.
Yeah.
My understanding of these things basically is that this is all done algorithmically. So I'm not saying the adjustments necessarily happen algorithmically, but the signals are algorithmic. because it's taking into account all of those variables. So as volatility were to keep climbing higher, there would be more of a shift from stocks to bonds.
Yes. The key principle, which is kind of an empirical observation for the markets in general, is the idea that for the most part, markets rise slowly, but they fall rapidly.
Right.
So volatility is a measurement of movement, and more specifically, movement over a time period.
Right.
And generally speaking, high volatility is moments of sharp market decline.
Yep.
If we look at the VIX, and we lay the VIX over something like the S&P 500 chart, what we generally see is spikes in the VIX correspond with big drops in the S&P 500.
Right. Yep.
So the theory here is if we are trying to control volatility, we will minimize the impact of those declines.
Right.
It's not perfect, though. There are times that volatility arises because of a big boom in the market. And sadly, that would also cause a VCI to allocate to the low risk asset.
Right. Yeah, they're really, I mean, this is my rudimentary understanding of this. They're not meant to outperform.
No, not at all.
They're meant to smooth things. So if you want to start with a con first, the con could be, you could make the argument that, well, you're going to cut off some of the tops. Or maybe the more accurate way is you're not going to participate as early in the upside at times. It just depends on what happens. It also depends on, you mentioned the time frame that they look at for as an example, the VIX, right? How quickly things move depends on that time frame that they use.
Yep.
So, if they used a 5-day versus a 20-day versus a 100-day, you're going to have different outcomes. And my understanding is 20-day is kind of the norm, but don't quote me on that, anyone.
Yeah.
Because
it is different. There are different VCIs.
Yeah.
Created by different institutions.
Yep.
And there are certainly different insurance companies or different selection within insurance companies when it comes to what VCI they're using inside their product.
Yeah. But I should, just to tag on, my understanding is that they're not meant to outperform to the upside. What they're meant to do really is control the downside.
Right. The whole concept is born out of the insurance industry, and it's more specifically tailored to the idea of indexing, fixed indexed annuities and indexed universal life insurance. And the premise or the motivation is one of the most unhappy aspects of an indexed annuity or an indexed universal life insurance policy is the year the index is down. Right. Because when the index is down, generally that's a zero credit year.
Right.
People don't like that because their cash value just sits there and does nothing. And if it's a product that has expenses, like an indexed universal life policy or an indexed annuity with some sort of rider that is deducted from cash value, that means we're actually going to see it go down slightly.
Yep.
We don't like that. So we're trying to get rid of the years that happens. The cost of that is it's certainly not going to perform in the good times like the S&P 500 is.
Right. And it's not perfect. You're still going to end up with 0 years.
You are. And you're going to end up,
well know.
You're going to end up in some cases with 0 years where the shift into the lower risk asset was arguably a worse move.
Right. Yep.
That has played out.
Yep.
So,
but the idea, of course, like everything else, is that you look at over a long term.
Yes, correct. Yes, the individual example where it didn't work out all that well does not say it doesn't work at all.
Right.
So, the industry's desire, we just covered that really the chief original motivation was, let's try to solve this problem of 0 years.
Mm-hmm.
There are some other things at play, though. So when it comes to indexing as a feature inside an insurance contract, the whole thing is built off options.
Right.
So puts, calls, things like that.
Mm-hmm.
And the amount of potential gain that can be created from an indexed account is highly dependent on the pricing of those options.
Right.
So the cool thing about volatility controlled index options or indices is the fact that they are relatively low when it comes to volatility. Low volatility means option pricing kind of sits pretty stable.
Right.
So that gives the insurance company more flexibility when it comes to the potential upside of an index based on volatility control.
Mm-hmm. Mm-hmm.
It also gives them substantially more stability year over year in terms of the pricing, which leads to far less frequent changes of things like caps and participation rates.
Right.
So something that has been discussed pretty much at length here and elsewhere on the subject of indexing products, indexed universal life insurance, indexed annuities, is the fact that if we go back 20 years, we'll see cap rates have changed.
Yep.
They've changed.
Absolutely.
They've changed considerably. Like your old traditional S&P 500 with a, I don't know, somewhere between 12 and 15% cap rate on an indexed universal life insurance policy, which was the norm back in like 2010, is not anywhere near that level today.
Right.
And the chief driver of that has been in part option pricing, and then of course lower interest rates for bonds that were purchased to create the budget to buy those options.
Yep.
Volatility controlled indices have had far less dramatic declines in cap rates, in more so participation rates, because those are more commonly discussed. So what I mean by that is most VCI based index options don't have a cap rate. Instead, they just have a participation rate, which is generally more than 100%. So you're getting the movement in the index times, let's say 1.75 or something like that.
Right. So you're saying the basic reason that the insurance industry is doing this is to reduce costs?
Yes, exactly. Exactly. And it gives them more flexibility to create an index that doesn't have near as much volatility in terms of the participation rate or the cap.
Right.
Not that it's zero, but it's there.
Yep.
This has led to a little bit of criticism in the sense that you may look at a product that has a S&P 500 index account on an indexed universal life insurance policy. And let's say it's got a cap rate of 10%.
Mm-hmm.
And then you look at a volatility controlled index, and that index has no cap, and it's got a 200% participation rate.
Right.
So S&P 500's, whatever the movement is, up to 10%. But then you look at the volatility controlled index and you go, oh, it's the movement in volatility controlled index times 2.
Yep.
So maybe I could get like S&P 500 like returns times 2.
And
there are even some agents.
Really nice, but
there are even some agents selling it in that sort of dream. That's not going to happen with volatility controlled indices. It's just not going to happen. They are not going to create a return, as you already pointed out, anywhere near what we would expect the S&P 500 to be on a consistent basis.
Right.
So if we're expecting the S&P 500 to do something in the neighbor of 8 to 10%, for the most part, average long term, we would probably see volatility controlled index accounts half that.
Yeah.
Which means, interestingly enough, the two are going to keep somewhat pace with one another so long as participation rates stay close to this 2 times amount.
Right. Right. Which no one can predict whether that's going to happen or
not. No, we cannot. Also, to look deeper under the hood in a way that certainly no one's going to ask us to, but we're going to do because we're us. There is a certain amount of regulatory reserving relief that comes from volatility controlled indices.
Yep.
So the way that insurers must hold reserves to back the liabilities created by insurance products is different, and different in a way that's more favorable to the insurer when they use volatility controlled indices versus some of the more traditional index accounts.
Right.
Now, lastly, to satisfy the cravings of the people who wear tinfoil hats, yes, in some cases there are also some instances where we're pretty sure volatility controlled indices were used to kind of game the illustration system.
Yeah, because they backtest a whole lot better.
They do. They backtest better. Plus, it also it addressed a problem that was created with certain regulation that was eliminating the use of bonus assumptions in illustrations, but allowed the insurer to kind of boost the assumed index earning because of the high participation rate.
Yeah.
So, yep, it happens.
So you're saying some of these might not perform as well as they're illustrated. What you're saying?
They might not perform as well as they're illustrated when we're using the absolute maximum assumptions that can be made.
Yeah. Basically, it's the same old problem in a new suit.
But the thing that's always been interesting about that, to me at least, is when you look at what is being argued from the, hey, look what this has the quote unquote potential to do. And you think about what it's doing from the back test, for example.
Right.
And you go, oh, wait a minute. The quote unquote potential is telling me something like 9% year over year in perpetuity.
Right.
But the back test is showing me something like 7.25% best case scenario.
Yep.
The math isn't mathing.
No.
And that's been a perpetual issue inside the indexed universal life space and index annuity space somewhat for a long time. To me, I think if you can reasonably do a little bit of number crunching and look at the results and go, that seems awfully high, the information's already yelling at you that it's wrong in that case.
Yep.
But I'm being me.
No, I mean, our philosophy's always been to, well, we never use maximum illustrated assumed rates.
No.
We look at the data and decide what we're comfortable assuming based on where things are now, where they have been, what's likely. I'll repeat something we've always said to our clients, which is we much rather assume something lower and have no one's unhappy when it works out better. So,
right. So this obviously begs the question, is there any benefit to these things? And I think it's fair to say that there is, but they are by no means the 100% solution to any of the potential drawbacks that people see towards owning indexed universal life insurance or an indexed annuity.
Right.
They absolutely bring a certain level of diversification to the table, which is cool. I think I'm correct in speaking for you on this. We applaud the industry's efforts to innovate and bring greater optionality to the marketplace.
Yes.
That
100%.
We have no problem with. So the establishment of volatility controlled indices as a way to tell people, look, you can buy indexed universal life insurance and you don't have to just rely on one single index option, the S&P 500, as the driver of interest paid on your cash value. I'm in favor of that.
Yeah.
I think that brings more to the table in a very, very favorable way. It spreads out the risk of things. We already believe that indexed universal life insurance, in the most traditional sense of just following the S&P 500, is not a market-driven product, and it certainly doesn't hold a tight correlation to market results.
No.
This is yet one more way of further separating your risk exposure to simply the movement in the S&P 500.
Yeah.
Which is what a lot of people want when they're looking at life insurance. As we noted already, the typical composition of a VCI puts it in a position where it has a strong chance of at least pacing, not beating, but pacing what we traditionally see happening in an S&P 500 style account. This, of course, assumes that we keep these participation rates that are well above 100%.
Right.
The other thing that is noteworthy here, and this is some data that we pulled up. This was, who put this? Allianz put this out. So they were showing us, or well, not showing us. They were showing certain regulatory bodies. I think it was the Life, LATF. I can't remember what that stands for. Task Force, Life Actuarial Task Force, part of the NAIC. When they were contemplating various regulatory moves regarding indexed products in the context specifically of volatility controlled indices. And the point that they made was several, but an interesting one was, this is the difference in terms of VCI performance and S&P 500 performance on our block of index products going from 2003 through 2023. And there's a number of different data points, but the one that was most interesting was the one that spoke to the elimination of 0 years.
Mm-hmm.
And the Allianz data showed us it happens half as often with VCIs as it does a standard S&P 500 indexed account.
Mm.
So the numbers from 2003 to 2023, 28% of the time for S&P 500 index account, just normal S&P 500 index account, 12% of the time with a VCI.
Right. So essentially, at least historically, it's done what it's supposed to do.
Right. The numbers bear out the fact that it is capable of reducing the years that zeros happen.
Yeah. Well, and while this is new to insurance companies using, I mean, relatively new, not brand new. Mm-hmm. This sort of strategy is not new in general.
No, the basic principle of it, I mean, all of kind of traditional portfolio modeling in a managed sense has largely been about protecting downside.
Yeah.
More so, I would argue, than beating the market, because it turns out that's really hard to do.
I know for a fact that's true. I mean, that's one of the things, that's a big, I wish I could think of the dog whistle. That's the term I was looking for. Amongst the personal finance crowd, they like to quote statistics that professional managers rarely beat the S&P 500. It's like, most professional managers aren't trying to. So,
right.
Well, I mean, there's thousands of money managers, first of all. And most of them have a particular specialty.
Mm-hmm.
And beating the S&P 500 may or may not be what they're trying to do.
Much more frequently, it's trying to underperform the decline.
Yeah.
When it happens.
So that people stay invested.
Mm-hmm.
That's the psychology there.
Yep. Now, there is pushback, and it's reasonable pushback. One of the key things is that the functionality of indexing, the zero floor, the annual reset, all of that is already reducing a substantial amount of risk that somebody would otherwise face if they were just fully invested in the market.
Yep.
So we're laying on additional protections that may be unnecessary, given how already good traditional indexing works when we're following something like the S&P 500. That same data pool from Allianz I mentioned earlier noted that the standard deviation of the S&P 500 index account from that 2003 to 2023 period was just 4.7%. That's like 25% of the regular standard deviation of the S&P 500.
Yep.
So volatility has already been majorly declined.
It's already been controlled just in the standard S&P 500 index account.
Yep.
To some degree.
For what it's worth, same time period, the standard deviation for VCIs was like a half of that.
Yeah.
So, substantially lower still.
Yes.
Again, bearing out that the concept works to do what it was designed to do. Also, some of the evidence that exists to support VCIs is driven by hypothetical backdating. Basically saying, okay, this is the composition of the index. So given what we already know happened, this is what it would have theoretically done in that moment.
Right.
Which is potentially true, but we don't know for certain that the algorithm, for example, would have triggered successfully as it's supposed to.
Yeah.
So when we look at historical data, 2008 is an interesting year because there's a number of VCIs that show they would have performed somewhere between like 2 and 8% for the year, which everyone at the time would have killed for.
Yeah.
But a number of those VCIs didn't exist when that happened.
Yep.
And so we're hypothesizing that this is what would have happened. But we don't actually have a real test like a 2008 to prove that, yep, it worked.
Yeah. 2022 probably was the most recent.
Which is not one the VCI crowd wants to talk about.
Yeah. Because everything went down.
Unfortunately, the shift to bonds was not a shift to safety, and VCIs went down.
Yeah.
Similarly to the stock market, because bonds went down similarly to the stock market. That move to safety didn't end up cutting any losses.
Yeah.
But
well, see, it seems in our modern world, this is just, conjecture, not advice. So please don't take it this way. It seems that to me, compared to when I got into the industry 25 years ago, we were trained about the inverse correlation between stocks and bonds. Mm-hmm. They don't look all that inversely correlated anymore.
No.
And I mean, the speculation comes as to why that is. And that's, who knows? There's a host of factors would be my guess. But
yeah, there are many estimations. But you are correct. And we've known, because it was an early episode of Podcasting for You and I, discussions about the fact that bonds and stocks were way, way more tightly correlated than was originally theorized.
Yeah.
And so the flight to safety isn't a real flight to safety when that's happening.
Right.
Because if stocks go down, bonds will go down with them.
Well, I think it's not in terms of raw return, but if you look at it in terms of principal risk.
Yeah.
That's
which is a key element to most retail investors when it comes to bonds.
Right. And it also is, not to drill down too deep on this, because this is not an investment podcast. This is a life insurance podcast. But there's a difference between buying bond funds, whether that's ETFs or mutual funds.
Yeah.
And buying individual bonds.
Big difference.
So
very big practical difference. Most retail investors don't really catch on to that because most retail investors don't buy individual bonds outside of treasuries.
Right. Not saying that individual bonds don't go down in value. That's not, please don't hear what I'm not saying.
They do.
Not what I'm saying. Of course they do. But
when you own an individual bond, you have the option. Sell it at a loss or just keep collecting the income.
Yep. And at maturity, you get your principal back.
Right. If you own a bond fund, there's a lot of decisions that are going to be made for you, and they're not always going to be made in your best interest.
Right.
Well,
I shouldn't say you get your principal back. You get the face value of the bond back. I don't know what you paid for it. So I don't know whether you're getting all your principal. If you paid a premium, then no, you're not.
Yep.
But
so again, it comes down to diversification.
Right.
When it comes to VCIs.
Yep.
And they bring great diversification to the table. And you and I have commented on this before, and this is unfolding now. The interest in indexed products, especially in the context of life insurance, like indexed universal life insurance versus whole life insurance.
Yeah.
There's been a dramatic shift
in
the number of people who now want to buy indexed universal life insurance over whole life insurance.
Correct.
10 years ago, this would not at all be what we were telling you.
Right.
Whole life insurance was the dominantly favored option.
Yeah.
And that's not true anymore.
No.
And I will argue in part it's not true anymore because of the robustness that has come about with indexed universal life insurance.
Right.
Some of the earlier concerns are being wiped away from stuff like this.
Yep. We would argue that those concerns were not all that well founded.
No, they weren't.
I mean, zeros happen. It's not the end of the world. I mean, there's definitely contracts that we manage for, that we sold to clients that have had 0 years.
Yep. And ones that were sold in that 10-year ago time frame, they've done just fine.
Yeah.
So we don't have as much innovation on the whole life side for a number of different reasons. So it just didn't happen. But the more creativity we can get, the better these products tend to get. There's always, always, always a marginality to that. So some companies go off the rails and go too far. There's no denying it. But innovation is a good thing.
I agree.
And I think that's a good place to leave it.
Sounds good.
So I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.